when we're talking about AI, you know, it's kind of a new paradigm, and we've got to assess this, and this is kind of what I associate with football, like a halftime adjustment. Do I need to? So, we all have to think about potential of AI and how it's going to affect the market going forward. While the valuations were super high last year, there's a lot of room to run, you know, in the new generation. How long did the internet, you know, boom last? At least, you know, we're still 2 decades into it. So there's at least potentially, you know, tremendous growth for the next decade or two in AI. And how many people, you know, regretted not getting into Amazon or Yahoo or Cisco, you know, in the early days. So might be worth having at least a small piece of your portfolio into such things. How we do next? Well,
Recording in progress.
so here's where we started getting into the private, you know, after we talked about the macro and public stuff, putting some numbers with the trend. 23 saw a 42% decline in dollar venture funding, which is about a third of what it was in 21. And quarter by quarter, not just annually, it was the worst year in 6 years. So the worst quarter in 6 years. So sequentially, the fourth quarter was even worse than the first 3 quarters of the year. So makes us wonder where we're headed. But as I said, things seem to level out and start picking up in a more balanced way in early in 24. So a little more granularly sector-wise, which I mentioned we have to consider, fintech and rebounded after a really rough 22, and retail actually did better than expected. But digital health, which was really hot in 22, it's fallen back almost 40%. Size-wise, the later stage, the unicorns, the ones that were attracting huge investments and, you know, multi-billion-dollar valuations, were the first to take a big hit, and then it trickled down to the mid-stage companies. But the early stage hasn't been hit as much as the the hits just keep on coming in. So yeah, I mentioned you know, the early stage, it's somewhat encouraging. Things didn't have much further to go, you know, to suffer. So I think there's nothing really but upside on the early stage at this point. And I mentioned that M&A didn't get hit. It's down, but not quite as much as the IPO one. So important to know your audience, and I call that the home field advantage for those of us in Atlanta. You have to know what flies in Atlanta. You know, I mean, yeah, if a $10 million valuation for a really pre-revenue company might have a chance out in the Valley or in Austin, Texas, or New York, but investors here have always been much more conservative and want to see more traction.
No, it's not close.
As a result, it's more stable. People tend to think about investing here more than speculating. So another reason to moderate your valuation asks in Atlanta. As in sports and football, analytics has become an essential part of the game. And the more data you have, the better you can assess your valuations. The mythical 10x revenue valuations never were really a thing. And if they were at all, it only occurred in multi-billion-dollar public software companies. So the data that's out there, typically revenue multiples, even for software companies, are in the 2 to 4 range. And here we see that on the left. They've hit a peak of about 6 in 2021, but fallen back to about 2. And on the EBITDA side, we're seeing, increased earnings. Multiples are high, maybe earnings are lower, but that can be, there are pros and cons to that. But EBITDA multiples are always more reliable as a valuation assessment point than revenue multiples, because we're really more concerned with what a company makes than what it does top line. Companies can have very different margins. 2 companies that make $10 million in revenue even might have very different EBITDA margins. So you're always wanting to look at how much they make, not bottom line, as opposed to just top line. Revenue multiples can be very misleading.
Is that data still Atlanta or is that?
This is national. Yeah. So, and another extremely important point, as I sort of alluded to with the 10x revenue multiple myth, when it at all only applies to really large companies, the correlation between size and multiple is almost always apparent when we do valuations and we list the comps, the comparable public companies or M&A private transactions by size. 90+% of the time, what falls out is that the smaller comps have lower multiples. And so we see in these M&A transactions with deal size less than 5 million or less than 20 million, they're typically much lower. And as it grows to 50 to 100, 100 to 500, and so on, the multiples, revenue multiples, and EBITDA multiples increase. So companies that might have a couple $1 million in revenue or a little bit of EBITDA might say, well, I think I should have a 6 or 8 or 10x multiple, revenue multiple, not wise to be influenced by multiples from larger companies and larger transactions.
Is there generally like a bright line, like once you go $1 million in EBITDA, for example, is that when you get a actual take?
There are inflection points, certainly. Yeah, that's a good question, good point. We see companies that reach $1 million, I'd say $500,000 get in revenue will get you up, a tier in valuation as you're getting going, and then $1 million in revenue will get you going in the early before there's positive cash flow. But then even achieving positive cash flow will be another point. So yeah, there's definitely inflection points that we see. So people ask, how do you do this? How do you do what you do? How do you value companies? And the answer is it depends on the stage. And as I said, companies with positive cash flow are easier to value because you have more options. Most people that have gone to business school, taken a finance class, understand discounted cash flows. And by definition, the value of any company is the present value of its future cash flows. So we will do that in combination with looking at EBITDA multiples from public companies and private M&A deals. So we can triangulate a value that with more confidence for a more mature company. Going back down the scale for companies that aren't profitable, there's no such thing as applying an EBITDA multiple to a negative EBITDA value, and you cannot discount negative cash flows in the future. So you're stuck with revenue multiples. And not as reliable, but it's really all you have. So we make the best of it. And when there's not even enough revenue, pre-revenue or just a little bit, such that applying a revenue multiple to $100,000 in revenue doesn't create a meaningful answer, what do you do then? So this is something that Integgra, my firm, does, that I think very few of any others I know of actually apply in a meaningful way. There's something called a scorecard method. And I didn't invent it. There was a white paper out there by an academic several years ago that was very well thought of, and I kind of took his theory and worked it into a spreadsheet. And to be able to provide a more objective analysis to something that's very subjective. So I created a worksheet, and it's got two phases. In the first phase, I sort of described at the macro level is taking a national median angel stage number, adjusting it for size, sector, location, and the time of the year-to-date period, just to come up with a top line number. So at that point, let's say we came up with a $4 million value for a national angel stage median valuation. Then we go through the scorecard and ask company specific questions to assess on about 6 different categories a variable, and to come up with a factor or a score to apply to that 4 million. So some of you may have seen me present before. Can anybody remember or guess what the #1 factor is in a weighted assessment of a startup that's pre-revenue? What do people care about the most?
The team.
The team, yes, the experience, exactly. So the old line about bet on the jockey, not the horse, or bet on the quarterback, not. I think Kansas City might not have had the best team. People say San Francisco had the best team, but they had the better quarterback. And they pulled it out. So the categories include the founders, the market size, the intellectual property, the funding situation, the financial situation, and well, I might be missing 1 or 2, and there's some miscellaneous market factors as well. But certainly, I think about 30% of the weight goes to the founding team. And here's a quick look at, list those factors on the left that we haircut to get to the top line. Here's the other: the size, the strength of the product, the competition. I missed that one. Marketing and sales partners in place, distribution channels, and funding. So let's say all of those things come up to a score of 1.25, which means you're better than average. You apply that to the 4 million, and you get a 5 million 3-month valuation. So generally, quickly, how we look at it. And here's a quick example. We have an angel stage company in the Southeast that's pre-revenue, B2B SaaS, healthcare IT, first-time CEO as of February in a given year. So if we had that at the end of 22, roughly a $5 million national angel stage median valuation, then we look at, the Southeast typically gets a lower valuation than the rest of the country, so that's minus 20%. Pre-revenue, $0, dollars in revenue, another 10% discount. The B2B SaaS is a good thing, so we're going to get a 30% premium for that. Year to date at that point, the market was up a little, 10%. So, and then the company's specific score, given that there's a first-time CEO and other things, it was only 0.8. So there's a 20% discount. So all of those go into the blender, and you come up with a more meaningful, low 4 million valuation than a $5 million valuation. And sophisticated, experienced investors, Sig Mosley, for example, is the godfather of angel investing here in Atlanta. I show him this and he's like, yeah, and yes, I do that in my head. He doesn't even know that he doesn't, but those are the things that he considers, and he intuitively comes up. He says, yeah, it's about 3, or that one's about 5. Or he just can intuitively assess things that way. But there's a range generally for pre-revenue companies in Atlanta. Probably between, 2.5 to 5 million that will fly. But if you push it past 5, you're gonna get in your own way a little bit and risk not having potential investors listen to how great your product or service is. And they might just throw it out before saying, well, 8 million's too much, so we're next. So that's the risk, and why I'm here to try to work with founders at ATDC and the Atlanta Technology Angel and TiE to try to keep you in the game. I mean, that's really what I'm here. I'm here to create positive outcomes for people, which is really the purpose of valuation is to create positive outcomes. And finally, an important factor in football, is motivation. It's an intangible, but what motivates people in a valuation sense are stock options. People take lower salaries to get equity, future equity and stock options. And there are discounts applicable to private company equity for two main things. It's the lack of control. We talked about not giving up control. If you don't have voting rights, that's a discount that you receive on your option price. And since they're private companies that aren't liquid, you can't trade them on E-Trade and get your cash in a couple days. That's illiquidity or lack of marketability. And so both discounts can be substantial in the neighborhood total of about 50%. And that creates a lot more incentive and motivation for employees to say, I have a chance to make some money here if I stick around for an exit. So, and that's an important thing valuation providers sign off on to make sure that it's justifiable and that the IRS, who supervises such things, don't put their foot down and say, wait, that's way too aggressive. Not everybody should get a penny, like in the old days. In the first .com boom, there was no requirement for independent valuators to opine on the option prices. Companies just made them up. And why not give everybody a penny if nobody's, watching? So watch the new BlackBerry miniseries on Netflix, and you'll be reminded that BlackBerry got in trouble for that, for giving developers from Google and Microsoft, really cheap, backdated stock options. So there had to be some guardrails put in, and that happened after the bust in 2004. The Sarbanes-Oxley financial regulations came in, and that included IRS 409, and it's kind of the Valuation Employment Act that's kept me busy ever since. So, what's the point of all this? What are we striving for? As I said, you heard that I like my football, and I just came back from the Super Bowl. Yes, I was there in Vegas. And, I think by what we're all trying for is to achieve financial freedom, whether it's working for big companies, investing, trying to figure out the private company game, sell our companies, reach an exit. We're trying to create freedom, I think, to follow our dreams. And so I've had a dream since I was little to have the freedom to dig into my family's past and research a story that I heard from my grandmother growing up in Pittsburgh, that my great-grandfather was one of the great players of the pre-NFL professional era of football. And not very many people even know that there was such a thing. They think that the NFL just kind of came fully formed out of the womb, but it did not. There were 28 years of professional football before the NFL was founded in 1920. So I wrote this book. I spent 15 years researching, writing, and editing and laying out a beautiful coffee table book that just came out officially in August. And with the encouragement of the Hall of Fame in Canton, Ohio, I venture down this road to use the photos I inherited from my family and combine them with research of the lost story of the pioneers of pro football to write this book and take it out to Vegas and show it around on Media Row to all the NFL community that I could meet. So it is called Gridiron Legacy, and it is my passion project, which is essential to success in sport and business. And the legacy is, I think, sort of a combination of the legacy, the game's legacy, as well as the legacy that I am hoping to build and leave for both my family and for the football world. So it's gotten great feedback, and I had a great experience living the dream that I hoped out in Vegas on Media Row, meeting several football stars and doing several interviews out there on the radio and streaming. There's, among others, Brian Billick, who coached the Ravens to the Super Bowl win. Lower left is the Hunt family that owns the Chiefs, the mom and the daughter there. Baker Mayfield of the Bucks, Cam Hayward, who just won NFL Man of the Year from the Steelers, and James Harrison, who was just the man. Probably the greatest play in Super Bowl history when he ran that 100-yard interception back against the Cardinals 10 years or so ago. So I just had a ball, and the book's taken off, and there are some available in the back for anybody that's interested. But I encourage you all, and I think the point of what I've done with the book is to discover your own legacy. Mine is just an example, one example of what we're all capable of doing by working hard, setting ourselves up for freedom and opportunity to go do something with your passions that you've always dreamed of, to establish your legacy. So thanks for listening to that little pitch, if you will, and yeah. Any other questions? Fire away.
Awesome, we can start on the Q&A part. Does anyone have any questions for Greg? Any valuation questions? We have one right here.
Yeah.
And then Greg, if you can do me a favor, just repeat the question back over.
So the 409A is not applicable if you're giving options to non-citizens like foreigners or so, or is that still applicable?
It depends on the country. It's not, it's only applicable in the United States. The question is,
For a C corp, for the Delaware C corp, I have Delaware C corp, but some of the option holders are they're foreigners, so they're not Americans.
so our 409A valuation option applicable to foreign employees. I guess if they pay taxes in the US, I think
They don't pay taxes.
then it's probably not relevant.
That's what I was told, but I just wanted to confirm from such a
I have several clients who are international headquarters, but they have US subsidiaries, and those employees get options and pay tax here, so they need that.
But if I give it to somebody here, then I'll have to go through the whole process of getting the evaluation.
Yes.
And
And it's an annual thing. 409As are good for 12 months from the valuation date, not the report date. So let's say your financials are 12/31 and you want to have that as your valuation date. The analysis might not be done until February or March by the time you get your books closed and everything else. But when you issue the options, they're good until the following December, and then it has to be.
so it has to be redone every
Every
year, even
year.
if you don't have any, like say, for example, if you don't give any additional options, or there's no other change,
Right.
right, in the
Well,
structure of
if
the company.
you're not issuing options, then you don't, but if you want to issue options, you have to have a valid 409 in place. So if you issued options in January of 22, you had to have that 12/31/21, thing in place. Maybe you don't want to issue options again until June of 23, you can get by with a gap of a few months and not maybe matters to save a little money to hold on until March or April, but you can't issue options unless you have one in place. And sometimes there's a panic, oh, I want to issue options, but I waited. And I'm like, well, it's gonna take a little while to get that done. So, and employees start to panic, they want their options, and, you know, so the executives panic, but you know what they say about failure to plan. So it's always good to keep it updated, and it might need to be updated more often if there's what they call a material event, like a new funding, so that triggers one, you know, out of cycle. But it's not that expensive, you know, it's kind of like going to the dentist, you know, it's an annoyance, you know, but it's good practice.
Thank you.
Yes, for startups, pre-seed or pre-revenue time, I think in your slide it says the size, sector and everything. What about technology impacts in the evaluation? So sector is one of them. What about technology?
So in a company, typically the IP is not valued separately from the revenue or the cash flow. It's assumed that it contributes to the production of the revenue and the cash flow. So it's not additive to the value. So we don't get into valuing IP separately in a typical valuation, but it's for a pre-revenue company, it's a component of the score that will move, you know, influence the valuation in that sense. And then there are other types of valuations, such as, might be too technical, called a purchase price allocation, that after an acquisition, the purchase price paid for a company, it has to be allocated between the company's tangible assets and intangible assets. And then any surplus is allocated to goodwill on the company's financial statements. So there is a separate valuation of intellectual property potentially done in those situations. But that's its own type of exercise.
Gotcha. And how difficult to raise money in early stage of the companies without revenue in Atlanta Southeast region?
Right, so the question, how hard is it to raise money pre-revenue?
Yes.
It's very hard, and some complain that, you know, some groups that put themselves out there as angel investing groups that are, whose mission should be to find funding, facilitate funding for pure startups, are disadvantaged when pitching against companies that come in with material revenue. So investors like proof, you know, they like traction. And so I said, well, I came here to pitch, and, you know, the companies that had, you know, traction got the money. Yeah. So maybe those organizations should be a little more firm on who pitches, but, you know, the ones that are purely for pre-revenue, I mean, they have the longest odds, right? So they have the hardest time. And if they come in with big numbers for valuations, you know, apples to apples, am I gonna, two companies are asking for the same valuation, one's got $1 million in revenue, and the other hasn't proved that their thing sells. Which one are you gonna choose? It's
Kind of piggyback on the previous question, at least the 2A question. You have trends, you know, like NVIDIA, SMCI, all these, the big seven that are focusing on AI or machine learning.
Right.
And theoretically, we're supposed to be in a bubble, which I think is completely a mistake, because I think it's just gonna keep going and going for the next several years. How do you incorporate some type of factor as far as trending startups, trends within startups for creating a valuation?
what kind, question, what kind of trends do we look at in startup valuation? Is that?
How do you address, or how do you create a component in your formula to address the trends for evaluation of a startup.
Especially with the rocket,
Yeah,
type growth.
yeah,
I mean, there's no fundamental way to justify the types of valuations that those AI companies are getting. So it just becomes a trend. You want, as examples, look at Web3 has been a disaster, right? The metaverse has been a disaster. I mean, most people saw that coming. I don't believe people are gonna walk around with goggles very often and buy, I'm not gonna buy, anything in the metaverse, any type of real estate, or, it just doesn't make intuitive sense to me. The NFT thing didn't make any sense to me to buy the Bored Ape, it just didn't get it. But, how could you assign any value, people paying millions of dollars for these, emojis or whatever. So everybody agrees that AI is not that it's real, and it has, applications. You can't imagine healthcare, anything, solving cancer, who knows? But all we can do, I think, is watch the growth and the traction, and at different points, people get comfortable going from the leading edge or the cutting edge, or, when it just feels safe to them. So just like in the early .com, there's gonna be a lot of losers and, a few winners, and, diversify, practice good investment, theory and portfolio theory, so not putting all your eggs in one basket. And I think that's how people get hurt, is unsophisticated investors getting talked into something by a friend or an advisor, and, load up on this, it can't miss, it's got XYZ advantages. And maybe I wasn't gonna talk about this, but I think it is interesting. It's, I'm not a rookie to this anymore myself, and I don't like to pontificate all the time, like I'm a know-it-all. So I at some point wanted to participate and prove out, at least to myself, what I think I've learned, by watching and listening to all these pitches for so many years. So thinking that I maybe know a little more than the average bear, I started to dip my toes in the water and invest in some of these things that I've been hearing about. And the way it's played out, it is pretty much exactly how people that have done this forever, have described it. You're probably gonna win 1 out of 10 times, that's what you're hoping for. And I've probably done about 10 deals in the past 8-9 years since I started doing the investing. And I've had no exits, okay? So that's a long time to go without liquidity, without making any money, especially when you have a family and people that remind you of that. So, practicing good theory, it can only be a little piece of your overall portfolio. You're not gonna over out maybe 5 or 10% of your total wealth you can play with like that. And you have enough of them to hope for your 1 in 10, eventually build up to about 10 of them at least. And I've had more CEOs die than I've had exits. 2 of the 10 have passed away. Really sad. 1 committed suicide because of the business failure. They had a government contract, earmarks that were going to guarantee their production of this super fiber, bulletproof, lightweight material that would go on boats for the new military to be, more fuel, all these wonderful things. But then a certain administration came in and gutted the earmark process and stripped all, there was no more earmark. So they lost their earmark, all the investors lost everything. And, the guarantee of production went away. So, another CEO, sadly, an Atlanta-based, fabulous young CEO, a woman, died of cancer a year or two ago at this point, and, in an ag tech company. So she was literally a rocket scientist from Georgia Tech. She was brilliant, but that's life. And several others are kicking around. One, a craft brewery that Pete and I were talking about. We got, might have had too many beers at the pitch session. Got into that's kind of gone away at this point. And a few others muddling along, but there's gonna be one winner. Keep your eyes on the prize. Prize Picks is killing it right now. A daily fantasy sports company that we see advertised at the Brave Stadium on Monday Night Football. They're, I'm like, how can they afford all these ads? And then we saw the 23 financials. Woo, they're killing it. Can't reveal,
DraftKings is
but,
doing it too.
sorry,
DraftKings is another one.
yeah. Well, they're
That's not back.
there are downside risks and there's still the gambling, considerations and, state by state, more, some are coming, some are going. They can sue each other, that, it's not over, but there's, in the next few years, I think we're gonna see a big, success, exit, hopefully, but you never know when that comes. So, you have to ask yourself when you're going out to bid, why would that guy invest in my company? Why would he do this? It's so hard. If you're gonna win 1 out of 10 times, what do I have? Can I be that winner, that generates $100 million, $1 billion, do I have that kind of potential? Or am I just gonna be, that's what B2B companies tend to do better. There's more recurring revenue. There's more money to be spent. It's very difficult, especially as the founder of a B2C book. I know how hard it is to sell, $50 a unit, selling a few thousand books it is a big deal, but it doesn't move the revenue needle. I wouldn't invest in it. If it wasn't my passion. But you should buy it.
I will second that. I have nothing to do with the book, but it's a phenomenal read.
Thank you, sir. Yeah, we really did get it. People that get it and understand, how nobody told the story about Pro Football started? How does that slipped under the radar? Because when I was at the Super Bowl and asked people, players, media, one simple question: where did pro football start? Canton, Ohio, isn't it for the Hall of Fame? Nope.
I'm better when that was a trivia contest and three teams tied. The tiebreaker was when did the NFL begin? The closest guess to the correct date was 1960.
Yeah, that's 40 years off.
That's what.
The first Super Bowl was in 1967, but the NFL itself was founded in 1920. 1920.
Oh,
They had NFL 100 in 2020. So they were the fact, and they did a horrible job of explaining it to the world because there's not much known about. But I even took it basically back to the book of Genesis of pro football.
They didn't get really called the Super Bowl until when? It was
Super Bowl III was when they started calling it the Super Bowl. The NFL, AFL championship.
yeah.
So it was
So
gonna be, no, it was not.
Packers Chiefs was Super Bowl I.
Yeah.
And it was played trivia in the LA Coliseum. Yeah.
Three, that would have been the end of they would have been the end of the AFL, NFL championship game, is what it was called then.
Yeah,
If the Jets had not won that game.
in Super Bowl III, Joe Namath.
28
So,
Colts for 28 points, 28 points, baby. Anyway, 24.
the gambling, since you mentioned point spread, it turns out to be a big part of the reason that this story of the early pro football was lost, because if you know your baseball a little bit, and the Black Sox of 1919, that they lost the World Series on purpose. There was a similar scandal in the football world that caused pro football to end for 10 years after 1906. And then was resurrected into the NFL, and that's the drama within my book is that I solved the cold case. That's a revelation.